Well, today, my friends, I'm coming at you a little bit broken and hobbled. In fact, I shattered my ankle just a couple of weeks ago, but I realized the show must go on. And so with that in mind, I wanted to pick a topic today that would light me up, that would fire me up, because I'm normally standing when I do these videos, but today I'm actually sitting down. So today I'm gonna be talking to you about Dave Ramsey.
So when I was 24, I made a lot of mistakes buying things that I thought would make me wealthy quickly. I bought a lot of nothing down real estate. I went broke as a result.
So now, that quote has been used so many times to demonize one of the greatest wealth building tools of all time, which is real estate. And this is why most people stop. They hear quotes like this or people like this say things about real estate, and they assume Dave Ramsey went broke because of real estate. Nothing down deals must be risky. Debt must be dangerous. But what if I told you that that's not the lesson at all? Because here's the truth. I could show you thousands of people who bought nothing down real estate and didn't actually go broke. In fact, they built massive wealth, generating infinite returns. How? Because investing success isn't about picking the right deal, it's about becoming the right investor. And today I'm going to show you why winning in real estate has nothing to do with the market and has everything to do with you. By the end of this video, you'll know exactly how to use leverage the right way, how to eliminate downside risk, and how to build unstoppable momentum towards creating financial freedom. But first off, I want to welcome you to the Wealth Outside of Wall Street YouTube channel. My name is Ryan Lee, and our mission here on this channel is simple. It's to rise up, empower you with money so you can live free. We help driven individuals achieve financial freedom in 10 years or less using the passive income machine. And most people never get there to financial freedom because they fear or they misuse leverage. They think that investing is risky, so they hand their money over to the professionals and they just hope for the best. But my friends, that's not you. This video is about taking control, increasing your financial intelligence, and setting up a game that you cannot lose. Let me say that again. Setting up a game that you cannot lose. So if you're ready to think differently and invest smarter, I want you to first do this. Like, subscribe, and share this with friends, because friends, they don't let friends retire broke. So let's dive into the problem why investors sometimes lose in the game of real estate. Just like Dave Ramsey, most people think that investing is about picking the right deal. But my friends, that's a myth. Winning in real estate isn't about luck. It isn't about finding a unicorn investment. It's about understanding risk and mastering liquidity and using leverage correctly. Most investors, they don't lose because real estate is risky. They lose because they don't know how to play the game. So here's why most investors fail. Number one, they think risk is about losing money. Most people believe risk is simply the chance of losing money, but that's only part of the equation. When we don't truly understand risk, we can't control it. And if we can't control it, we can't engineer a game that we can win every single time. So risk is simply this, it's variation from the expected, which means there is downside risk and there is upside risk. On downside risk, when your outcome falls short of your expectations, you lose money or you make less than you were planning on. But there is an upside potential as well. When your outcome exceeds the expectations that you had within a given investment, or you make more than you expected, you're experiencing the positive side of risk. We get all excited about this side and we get sad when we have the downside risk. But there's one thing that's common across the board. It's expectations. Because if you don't control risk, you're not really investing, you're gambling. So the second thing I want you to understand about those who lose in investing is they don't align expectations with reality. Every investment exists within a range of possibilities. Let's take something pretty simple. Let's go with bonds, something that's pretty fixed and secure. The range of expectations on this is between 1% to 3%. It's low risk and low variation. Something maybe a little bit higher would be mutual funds, right? Maybe a 5 to a 10% return opportunity within a mutual fund. You have a little bit more variation, but it's still pretty constrained. Now in real estate, you have the opportunity to go to 20% returns and beyond. You have higher variation, but massive upside when it's done right. Managing risk isn't about avoiding, it's about understanding what's possible and aligning your expectations with reality. If you expect your stocks to double in a year or real estate to make you rich overnight, you're not managing risk, you're ignoring it. So here's the truth. Your expectations, not the investment, actually determine your risk. Someone expecting a 10% return, but only getting 3, they think that they lost money when in reality their expectation was wrong, not necessarily in the investment. Another investor may be expecting a 5% return, but getting a 15% return instead. He's experiencing the upside of risk in action. Risk isn't always about the asset class, it's about you, the investor. So understanding what's possible within a range of expectations is one of the keys to managing risk. Most people think they're losing when in reality they just had faulty expectations for the investment class that they chose. This brings me to point number 3, why most investors lose and why Dave Ramsey lost in the game of real estate. They lose because they ignore liquidity. The ultimate risk management tool is liquidity, especially if you're going to inject leverage into the equation of investing. Now, leverage is the most powerful financial tool that almost anyone has access to. Leverage is a force multiplier. It magnifies what you put in by adding more money to the equation via leverage. For example, if you're gonna go buy real estate, just a standard equation, you could put $1 in and a bank will give you $4 more. That's leverage in action. Now, leverage is a tool that can make you or it can break you if you don't understand this point. Point number 3. Liquidity. Leverage is what makes real estate the most powerful wealth building tool available. It allows you to control high value assets with a fraction of the cost. It multiplies your returns beyond any sort of traditional investments. But leverage, it is a double-edged sword. It can either make you financially free in under a decade, or it could send you running for the hills blaming real estate for your failures. Just like 24-year-old Dave Ramsey, who went broke buying nothing down real estate. Now, I'm not gonna fault Dave Ramsey. I've lost a lot of money in real estate, and every dollar that I've lost in real estate has been a lesson of how to more strategically use leverage. Because on the flip side of that lesson, I've made 10 times, 20 times, 30 times more than I've ever lost by getting smarter. This is the key here, my friends. You can actually get richer by getting smarter. Money is just a tool. And when you understand how to use the tool, meaning you've raised your financial intelligence, you can use leverage strategically to amplify your returns and almost completely minimize risk with step number 3. Because let's get something straight. Real estate wasn't the thing that wiped out Dave Ramsey. It wasn't the investment that was risky. It was how he mismanaged leverage. Winning in real estate isn't about picking the perfect deal. It's not about structuring the investment correctly. It's letting time do the heavy lifting. Your tenants, over a long enough period of time, they cover the mortgage. The value of your rental property appreciates. Your equity grows. And leverage turns a modest 4 to 5% annual appreciation rate on real estate into 20% plus returns simply because you have less money in the equation. But here's the catch with leverage. Leverage creates volatility. It tightens up your margin. When you generate income, you have to service your debt first. If you can't ride out the volatility in the short run, things like tenant turnover, unexpected repairs, short-term market dips, you're gonna lose. Not because real estate was risky, but because you weren't liquid enough to ride out the short-term volatility to get the asymmetric upside available to you in an asset class like real estate done with leverage. So let's talk about how people misuse leverage. Then we can understand how you can use leverage appropriately to create massive sums of wealth. Most people either avoid leverage altogether because they fear debt is bad. They listen to Dave Ramsey, who lost it all, apparently in nothing down real estate, when in reality he just wasn't liquid enough to ride out the deals that he did. Or they go all in on leverage and they overextend themselves, hoping that appreciation will bail them out and things that they don't necessarily have control of will make them rich overnight. They have faulty expectations. But here's the reality, my friends. Leverage, it's not good or bad. Just like money, it's just a tool. And just like a chainsaw, if you don't know how to use it, it will take your hand off. So if you use leverage without understanding risk and liquidity, you're going to lose. Not because the deal was bad necessarily, not because the real estate was risky, but because you were a risky investor. Hopefully this is sinking in for you, because the number one reason that investors fail when they use leverage is because they lack liquidity. Listen, my friends, I coach thousands of real estate investors. I've been a real estate investor for over a decade, and every single time I got myself to the edge or I saw other people getting to the edge or falling off the edge, it was always a problem with lack of liquidity. They overextended themselves, they mismanaged their liquidity equation, and therefore they weren't able to ride out any short-term volatility to experience the asymmetric upside that real estate always brings to the table. Most investors go all in without a safety net. They spend everything on the property, leaving nothing in reserve. They're completely unprepared with what happens if a tenant moves out or an unexpected repair pops up. Because if you run out of liquidity, you're forced to sell at the worst possible time. You sell in desperation. You sell when markets aren't favorable. You sell because you don't have the ability to ride it out to experience the potential of real estate given a long enough period of time. So liquidity isn't just a safety net, it is the key to upside. So here's what I want you to consider. If you're gonna get in the game of real estate, of using leverage, if you wanna create financial freedom in 10 years or less, which is really what this channel and our investment strategy, the Passive Income Machine, is all about, liquidity is what gives you permission to use the leverage in the first place. If you don't have liquidity, you can't sustain the volatility leverage creates. And if you can't sustain volatility, my friends, just like Dave Ramsey, you will lose. You'll whine about it, you'll cry about it, you'll create a radio show and tell millions of Americans to avoid debt like the plague, even though leverage is the only way to become financially free in today's markets. I want you to consider that. Our market is built on debt. If you're fighting against debt, you're fighting against the market, which means every step forward you're taking, the market is literally pushing you back. Our currency today is debt. And if you understand that simple thing, leverage can be a force multiplier. Now, most people, the alarm bells that go off, especially if they listen to Dave Ramsey, is debt is bad. Debt is bad. It wiped Dave Ramsey out. But I hope you're getting from this video, it wasn't debt that wiped Dave Ramsey out. It wasn't even real estate that wiped Dave Ramsey out. It was the lack of liquidity. It was the mismanagement of the debt that he took on. So let's talk about how to structure your investments to remove the downside risk while keeping unlimited upside potential. This is the solution to never lose, to build a game that you cannot lose. Because winning in real estate isn't about luck, it's not about timing the market, it's about engineering the game simply so you cannot lose it. And here are the 3 key principles to doing just that. Principle number 1 is liquidity is king. It's your insurance against loss. Leverage is kind of like loading up a one-sided barbell. If you don't counterbalance the one side of the barbell, the weight is gonna crash down right on your face. That's what using leverage is without liquidity. It's loading up a barbell, trying to bench press with having all of the weight on one side. But when you balance both sides of that barbell, you can lift with stability and control. Liquidity is the counterbalance to leverage. This is the single most important point of this video. Liquidity is what allows you to capture the asymmetric upside of real estate without getting crushed by the short-term volatility that leverage inevitably it's going to create short-term volatility. Liquidity keeps you in the game, and staying in the game is the key to compounding wealth. Most investors think liquidity is just about emergencies, but it's so much more than that. So with all of that being said, leverage must be controlled, not feared. Leverage is the most powerful tool in real estate when it's used correctly. But most people just misuse it. Smart investors use leverage like a precision tool. They use fixed rate debt that doesn't change over time. They ensure cash flow covers the mortgage so that the asset can pay for itself, and they use leverage to amplify returns and keep them in the game, not create unnecessary risk. I want you to consider this. This is exactly how banks operate. Banks are the ultimate model of leverage. That's their entire business, is running leverage. But for every dollar that they leverage, they have to have a certain amount kept in liquidity. Now, if you want to know where banks keep their liquidity, they keep their liquidity in overfunded high cash value life insurance policies for the exact same reason that I just shared with you. But that's a topic for another day. So here's what I want you to remember from this video. There is no such thing as a risky investment. There are only risky investors. If you structure your investments the right way, my friends, you can't lose. If you misuse leverage or ignore liquidity, you will lose even in a great deal. It's not the deal that's good or bad, it's you. It's your financial IQ that makes it good or bad. So the question is this: are you ready to start playing like the wealthy? If you want to learn how to invest in real estate with zero downside, here's what I want you to do next. If you're not subscribed to this channel, what are you doing? Subscribe to the channel. Drop me a comment down below and tell me what your biggest fear about investing is. And then check the link in the description, because if you want help building your very own wealth portfolio, we call it a passive income machine, where we use leverage strategically to create financial freedom in 10 years or less, I'll give you an opportunity in the link below to learn more about how to use leverage to create financial freedom in your life, no matter where you're starting. This game, it's not about luck, it's about playing to win. So go take control and win with money, because winning with money is winning with life.